Good morning, everyone, and welcome to our webinar. This is Courtney, the marketing coordinator here at AIM. Today's webinar will be recorded and later posted on our website. This does mean that all attendees will be automatically muted so that we can get a quality recording today. If you have any questions, feel free to type them into the question box and we'll try to answer them throughout the presentation. But if we're unable to get to all the questions, we'll have a member of our marketing team reach out to you individually to make sure we can get those answered. Remember, we do have webinars every Wednesday morning at 9 a.m. Pacific, so go ahead and keep an eye on your email or check out our website and get signed up for the next one as well. With that, we're going to get started this morning, so I'm going to hand this over to Derek so that we can get started. Go ahead and take it away, Derek.
Awesome. Thank you, Courtney. Hey, everyone. This is Derek with AIM, as Courtney just said. Today, I'm kind of excited to be going a little bit more in depth on specifically more One Life products, but there was quite a bit of agents out there who were hoping to dive a little bit further into Index Universal Life, which is always a fun product to talk about. There's a lot to it. Like I said in the last presentation or webinar, if you guys were there, I mean, you can make it as easy or complicated as you want. It's one of those things in the insurance industry. Obviously, it's around, people do sell it. But when you look at all that's out there, as far as actually products that you can sell as life insurance, it's not really much of a surprise that 40% of policies written are actually term policies. They're very easy to sell. They're very easy to understand, right? Clients get it. It's going to give you the most bang for your buck, but it doesn't mean they don't have their downsides, right? Just like all things in life, there's some pros and some cons, okay? And something else that's really important to kind of consider is even right now, about 52% of Americans have some form of life insurance, right? Some people look at that as, okay, the market's already, half full. There's not much opportunity there. The truth is, the nice thing when it comes to life with all these different products is there's going to be different stages in life where different products are going to be more beneficial to those clients, where they're going to understand it more, and it's going to be something they're more interested in. Or maybe some of those products, right, when they're saying, yeah, I have life insurance through somewhere, it's their work, right? It's something they may not be able to take with them. If they do, the premiums are going to change. There's a lot of different aspects that come into play, okay? So, like I said, we're going to be diving a bit more into Index Universal Life, specifically on this webinar, because it's kind of nice to have some time to get into that a little bit deeper. So we're going to start a little bit general, kind of high level for some of those, out there who are very much new to this product. It's basically just going to be a permanent form of life insurance. It's got some great benefits such as flexible premiums. You can even go ahead and have, your cash value pay for those premiums. Obviously, right, some of you guys are throwing up red flags. You're going to want to make sure there's enough cash value in there to be actually keep the policy alive and keep it from cannibalizing itself. And we're going to dive into that a little bit here coming up. But it's just one of those things that you'll learn with experience. We're going to touch on it here. But the nice side is permanent life insurance, very flexible. You can build it a lot of different ways. There is going to be cash value in there, right? That's going to be assigned, whether you do it as, a kind of indexed, right, account, which isn't going to actually be an equity position, which is kind of important to note, right? People aren't going out there and they're not picking options in a direct market, right? So there's going to be a little bit more protection and insulation from what's going on in the stock market. Also, there's fixed rates, right? And we're not going to go super in depth on, if you should choose the S&P 500, that's probably going to have a cap on it at about 10%, or if you should go into one of those non-capped kind of options, or if you should pick the fixed rate. That's going to get a little bit more into the weeds, and there's going to be different pros and cons. And to be 100% honest, as an agent, unless you're a financial advisor and you want to spend time kind of staying on top of that for your clients, I would probably just let it default, and this will make a little bit more sense here in a minute. I would just let it default to what it normally does, which is the S&P 500 at 100% allocation. Most of the tools you build with, that's just automatically where it's going to assign that cash value, right? So just kind of leave it for now when you're in there. The other nice thing about these is they're usually going to have some kind of cap, like I said, depending on what you choose, right? Not really a plus. But on the flip side, they're going to have a floor. There's going to be some kind of minimum, which is usually 0%. but it's still important to note that, because if the stock market does have a horrible year, right, there's not going to be some kind of negative return where they're coming back and taking that money away. They're at least going to get that 0%. A few terms you're going to want to familiarize yourself with, because this is going to get really important as we start stepping into the different ways you can build IULs, is TAMRA or 7Pay. Some people call it TAMRA 7Pay, right? The simplified kind of explanation of that is back in the late 80s, the government stepped in and they created a type of test to say, hey, this is a life insurance policy, or this is actually more of an investment, right? And if it's an investment, they're going to want to tax it appropriately, right? Everybody knows they're going to want to get the taxes from it. So that's one thing to familiarize yourself with. The other part that kind of goes in with that is a MEC, a modified endowment contract. Depending on who you talk to, they're going to kind of use those terms interchangeably. But like I said, it goes right in line with that, right? It's basically looking at the test over 7 years with the premiums that are going to be paid into it, which is going to determine, hey, is this an investment or is this life insurance? And like I said, we're keeping this a little bit high level, because even knowing these terms, right, and kind of what they mean is going to put you ahead of most people out there when it comes to building IULs. And it's going to be something that you don't necessarily have to know, okay, what percentage is going to qualify, of the premiums towards what the death benefit is, right? When you're building these in the quote tools, they're all going to have options that are going to have something that says, solve for TAMRA, solve for TAMRA 7Pay. They're going to have something that says prevent from becoming a MEC, right? They're going to have options in there, and it's going to solve for you, right? So you're going to want to know what they are to be able to select those options, but you don't necessarily have to know all the math that's going on that the computer is doing for you to prevent that from happening, okay? If you want to, go ahead, right? It's a good thing to know. But like I said, you really don't have to know it off the top of your head. When it comes to building these policies, something else you're going to want to know a little bit about is cash value accumulation test and guideline premium test. So when you're looking at the Internal Revenue Code, Section 7702, which is what most of these kind of tax rules are going to come from, right, is you can build these policies a couple different ways to figure out what's going to be more beneficial when it comes to getting those tax advantages, right? So when you use the CVAT or the cash value accumulation test, it's going to be looking at more of the cash value in the policy isn't going to exceed all the future premiums, right? And that's one test method. Another one it's going to solve for, like I said, is it's going to be looking at how much you can pay in premium wise compared to the death benefit, right? And each of these are going to have benefits. But the nice thing is, like I said, depending on what carrier you're going through, you'll either be able to toggle between the two and see what's going to be most tax advantageous, or certain carriers have certain products that, they will have two different types of IULs, and one's automatically solving, right, for the guideline premium test, the other one's solving for CVAT. So it keeps it pretty simplified for you, which means you really just kind of have to know what these terms mean, and then that way you can go forward and build it from there, right? Or if someone asks you about it, you're going to know what it is, right? But you don't have to actually know, okay, well, this is, 25%, and that's what it has to be, right? And that's just a random number, but it's one of those things that knowing these terms are definitely going to help out quite a bit. So another question I get a lot before we jump, right down the rabbit hole of IULs is, how do I know what route to take? How do I know what kind of IUL to build? How do I even know if I want to pitch an IUL, right, versus a term or whole life or whatever the case is? And some of this is going to be for newer agents. Some of this might be a good refresher for you agents who've been around forever. But there's a couple things that you want to try and remember, right? When you have that first meeting, and it doesn't matter whether it's going to be over the phone, Skype, in person. I will say when it comes to IULs, right, and I'm a millennial, right? I'm going to be 38 next month, right? For me, my time is very valuable, and I like to do a lot of things over Skype or the phone, especially because I grew up in the Seattle area and it could take me 2 hours to go 15 miles. So time was valuable, right? I didn't want to have to always be in person with stuff. But when it came to IULs, there's so much going on and so many moving parts, and you want to build that relationship as the expert, as the advisor, as the professional, right? That in person really is the best way to have these. Now, if you're talking about just term policies where it's plug and play, right? It's basically an assembly line, right? Of the customer can have any color car they want as long as it's black. Yeah, you can do that over the phone pretty easy, and that's part of the reason why a huge percentage of what's being sold is terms, right? But when you get into the weeds of IULs, you really want to sit down and go through it with the customer. That way, you can actually build not only that representation of, hey, I'm the expert, I know what's going on, right? Part of the reason we're covering some of these terms earlier on, but you can also actually sit down and have a real talk with them. And a good thing to do is build an agenda. Hey, we're going to talk about why we're having this conversation, what you're looking for, what you're hoping to get out of it, and you're going to lead the conversation. And you're going to do that through open-ended questions and closed-ended questions, right? And ideally, you want to have an idea of where those questions are going to go and what the answer might be. But some of those open-ended questions are going to be a little bit of kind of fishing, right? You're looking for stuff. So some good examples that are pretty easy close-ended questions, right, are you married? What do you guys do for work? Income. What kind of debt are we looking at? Do you have a mortgage? Are you planning on buying a house? Do you have kids? Are you planning on having kids, right? All pretty personal stuff, but it becomes very important for what policies you're going to offer and how you're going to do this. A lot of times when I sell IULs, I will do it with a term policy also, right? Because like I said, they both have their benefits and they both have their downfalls, right? But you're really going to want to try and figure out what they're looking for and kind of what adds value to them when it comes to an IUL. Is it the fact that they can borrow, from the policy later to get funds? Is it the fact that it's permanent and they don't have to worry about going out at age 60 and hoping they qualify to get another term, right? Just figuring out what they're actually looking for, right? And also read the room, right? I've had agents who I've worked with or talked to who are very big on trying to scare people. What's going to happen if your husband dies tomorrow, right? What are you going to do with the kids, right? Read the room. There's a lot of people out there who even talking about life insurance is almost putting a hex or a curse on it, right? If we talk about this or we get this policy, it means something bad's going to happen, right? So kind of feel out the situation and figure out what they're doing. And right, people can throw out stats all day, but another thing to remember is as we're getting a lot of these younger generations that are getting older, right? Right now, a poll from last year, 49% of Generation Z and 47% of millennials said that they need to either buy life insurance or they need to get more life insurance because they don't have enough, right? So pretty good numbers, right? 50% of the people almost that you're going to talk to in those kind of demographics feel like they need life insurance, right? Pretty easy target. Of those, 40% of Gen Z and about 30% of millennials, the only reason they haven't bought it is because they don't know what to get. They don't know what they need their death benefit to be. They don't know what kind of policy they should be looking at, right? Because we are getting flooded with social media and they are getting all these messages of you need to buy term, you need to buy an IUL, this is how we got rich, look what we did, right? And that's where it's still very important, even in the internet age, to have a professional that they can talk to that is going to offer them a solution, not a product. And that's why you have to have that kind of conversation of what they're hoping to get out of it. And ideally, you want them to come to that solution, right? You want them to think of the need that needs to be fixed. And you just get to come swooping in, right, and give them the answer to what they're worried about, right? Makes it so much easier to sell it. All right, so now that we've gotten all that information, right, you're going to want to choose a solution. So the big things that you're kind of looking for as far as building an IUL to kind of get to where they want to be is, are they hoping to get, some kind of protection to replace income if one of them passes away, whether that's now or in the future down the road? Are they hoping to get some kind of income supplement, right? Almost like an annuity to supplement their actual annuity down the road? Are they looking to just protect some debt? Are they looking to leave a legacy, which is going to be another big one where IULs are coming in very, very handy, right? Because there's a lot of tax benefits. And if you build this, towards going to a trust, a lot more, okay? Are they looking to actually set their grandchild or, you know, their kids up with some kind of college savings plan, right? And we're going to jump into that a little bit more. But you're getting those answers and you're going to be able to provide kind of a custom tailored IUL that's going to meet all their needs, which is also going to, include what they can actually afford, right? That's going to be a big one. And as we're stepping into some of these next slides, right, when you see the death benefit or the premium, don't fixate on either the premium or the death benefit, right, for these examples, because all that can be scaled up or scaled down to meet the customer's needs, okay? But make sure that when you're having those conversations, this is kind of what you're looking for a little bit on a simplified level. So it makes it easier to go, okay, I'm going to build this as more of an investment because that's what they're looking for. Or I'm going to build it as a cheap, easy life protection that's permanent, that's always going to be there, and they're going to have life insurance. All right. So to start off with, we're going to do Test McTest. He's a 40-year-old male. We did $1 million death benefit. And like I said, that initial premium's just under $600. Don't fixate on those numbers, but this is going to be more of a pure life insurance focused kind of build. The numbers are a little bit higher here just because I wanted to be able to actually show you guys how this is going to work and some of the benefits and cons and what's actually going on in the policy. And part of this too is where when we talked about that, GPT or CVAT is going to come into play, right? This is already taking one of those tests into consideration when it's building it, purely based off of the actual IUL policy I selected, right? So I don't even have to worry about that. It's just going to be built in there. It's going to test for it. It's something you're not going to have to pull out a calculator for and figure out what's going on, okay? But remember, $1 million death benefit, just under $600 for the premium. Little pricey, but just wanted to be able to illustrate kind of what's going on. As you notice here on the far left side, the end of policy year, I jumped all the way to 21. I didn't do the first kind of 20 years because I wanted to show a couple things that you can do with these builds. So starting at age 61, as you can kind of see over here under the annualized premium outlay. Don't know if you guys can see my little arrow, but it's kind of in that middle left. I don't have them paying any premium into this starting at age 61. That's a pretty common thing I do because a lot of people don't want to be paying into life insurance, right, when they're retired. They're going to be on some kind of fixed income usually. They don't want to end up insurance poor. And it's just a nice thing to start building in there. And the cool thing with IULs is you can build that into the policy at a certain point, some kind of stop pay when they're going to stop paying into it. And you can actually go over and look at all the values and make sure that the policy is, not going to cannibalize itself. In the best case on the far right, in the middle column on the far right, you'll see that it's actually growing for the cash value. In the middle column in the middle, right, you'll see that it's going down very slowly. So those are things you kind of want to look for whenever you start playing with, stopping a pay at a certain point, and that's keeping it pretty simplistic. But like I said, we could talk for 4 hours about this, right? This is going to be a lot of information that's going to put you quite a bit ahead of even other agents out there as far as what they actually know about what's going on with IULs. Something else to keep in mind. So this is going to be for the S&P 500, right, at 100% participation rate, okay? And that's what it's solving for. Like I said, that's usually going to be the default. And something to kind of note, and you don't have to write this down because it'll be higher up in whatever illustration you work. So when taking that into account, over 25 years, the average minimum return has been 3.93%, okay? That means that the average return for the minimum amount is higher than what they're putting in this middle column, which is 3.25%. When it comes to the average return, it's 6.28%, and the max return has been 7.71. Now, could have that have been a higher max? Yes, but usually when you're talking about the S&P 500, a lot of carriers are going to cap that at 10%, right? So even those years where there's a much better return, they're only going to get 10%. But this is kind of important because when you sit down with a client and you're showing them this and you're trying to make all this make sense to them, they're going to look a couple places. Usually they're going to look over here on this left under the guaranteed, right, which is 0%, and they're going to say, what's happening? Why does this go away, at age 66? Well, this is what's going to happen if it's actually returning at 0% for, what, made it all the way to 65 years, right? To be 100% honest, if there's ever a 0% return or worse, right, in the stock market for any number of years, what's going on with this life policy is going to be the least of their worries or our worries, right? That's going to be talking about the US probably going into default. The US dollar is probably going to be worthless, right? Because the stock market has completely just collapsed for X number of years. So something that, while possible, isn't going to really be a worry if that ever happens, okay? The other thing to point out on here, like I said, and this is more for you guys, don't necessarily go into this with them, is the minimum return over 25 years, which is including the recession, it's including COVID, it's including all these kind of downturns in the market, which have been pretty substantial, is 3.93%, right? So the minimum return is higher than what we have in this middle alternate scale, non-guaranteed, okay? So when I do talk to customers or clients, I still play it safe, right? Because a lot of people who are used to these, who stopped selling these from the 90s, these values they used to guarantee or non-guarantee, especially on the right side, were usually going to be that max, right? They'd be showing a return over here of 7.7% or 8%. And here in the middle, they'd have 5 or 6%, right? And then on the far left, they would have that minimum of 3.93%. And they didn't really, turn out the way they were supposed to because they were kind of over-promising, right? It's why on a lot of these newer illustrations, no matter who you go through, they're going to play it very conservatively. And as an agent, I'd rather not use my E&O, right, and give a false kind of idea of what might happen and be like, yeah, this is where you're going to be at, right? I mean, even the average return is 6.28%. You should be above this, right? Usually what I'll tell them is you're probably going to be somewhere between these two numbers, right? I'm not going to promise that, obviously, right? But realistically, you'll probably be somewhere between there, right? So be careful with what you say. Don't promise anything. Don't show them, hey, the max return has been at 7.71%. The average has been at 6.28, right? You're going to be above this easy, right? Don't get into that, right? That's just going to set yourself up for future headaches, okay? But if you kind of stick with these numbers, you're pretty safe. And you don't even have to say that this is what it's going to be, right? You could just say that this is what they're illustrating your return at on the cash value, what it's going to grow at based off of what, the S&P 500 at 100% participation has done over the last 25 years, okay? And it's just a nice thing. And honestly, you're probably not going to get into all of that when you're talking about a life insurance focused kind of IUL because they're more concerned about having life insurance there for some kind of reason. But it's going to lead us a little bit into the next build, which is still going to be test McTest, right? 40-year-old. I bumped this up to 1.5 million. And I did a couple different things on this one. So this is going to be more of someone who is focused on using this as an investment. Maybe they want to kind of have it as a supplement for what they're going to be bringing in off their, annuities or whatever the case is, their retirement. Or you can kind of do a similar build for people who are looking to leave some kind of legacy and get around those taxes. I do recommend if you don't have one yet, try and get someone in your network who you work with who is a tax expert And you're going to start to see why as we get into all this stuff. Um, or, and not or, sorry, who's a lawyer, right? Who's going to be able to write up different kind of trusts and stuff like that to really take advantage of some of these tax advantages, right? It's a good thing to have in your back pocket to be like, hey, I can refer this here, okay? But you're going to notice a few different things, right? One, this monthly premium jumped way up, okay? $8,416. Um, Basically, what we're doing here is we are putting in the max amount of money that we can per year, right? Without this becoming a MEC, modified endowment contract, because this person wants to dump as much money into it as they can afford it, and they're trying to look for some of those tax advantages. Now, remember, like I said, you can build this with a smaller death benefit and a smaller premium. Obviously, right, it's not going to grow as fast, but you can do it. So this isn't only going to be for people who have a ton of money. There's other ways to build this on a smaller scale that's still going to be beneficial to a lot of different clients out there. Okay. So this one we did start in the beginning because I wanted to show you a few things. So kind of like we were talking about with that Tamra 7 pay, as you guys look on the left side over here at annualized premium, right? We have them dumping in about 100K a year for 7 years, and they're not going to pay any more after that, right? Big number, but it helps illustrate kind of how these values are going to grow and what's going to happen. Okay. So even starting at year 7, right? They're pretty close to what they've paid into it. But from there, it's going to start growing quite a bit. So by the time they hit, 20 years into the policy at age 60, um, they could be seeing around double the growth as far as what the cash value is at, right? And that's kind of the beauty of being able to dump in large amounts of money. Um, and it's going to keep growing from there because we're going to build this with the idea of, okay, we're going to try and dump in this much money to actually have this policy stay solvent and not, eat itself alive and disappear. Because like I said, this is someone who's hoping to use this as a supplement later on in life for whatever kind of retirement stuff they have planned, right? You don't want to make this the only income that they're going to be getting in retirement. It's more of something that's going to be there to help supplement what's in place, hopefully. Or if they already have everything there and they're just looking for some kind of other tax advantages, some other places to put some money, this is a good way to go, right? If they're already maxing out their 401k or different contributions in different places and they already have money here or there, this is a good place to start putting money, okay? Because it's into an insurance policy, right? That by itself has tax advantages now, okay? Um, so starting at age 61, I have them taking out about $90,000 a year, right? So remember, they were putting in about 100,000 for 7 years. Starting at 61, I have them taking out $90,000 a year. Here it goes all the way to 120 years old. Probably not going to live that long, but it's just a good example. So let's say they passed away at, you know, 105. And this has been going on, right? I had this start at age 60 where they started taking out money. So let's say they've been taking out money for, 41 years and they pass away, right? You can still see they have a pretty healthy, cash surrender value there as well as death benefit, right? That's going to be part of the legacy that's going to go to their spouse, whatever the case is, okay? And it's really important to note that this is where I said it's good to have kind of a tax professional in the play, right? You can kind of walk up to the weeds. You don't really want to dive in there too deep. um, but it's a good thing to note that when you're doing these distributions, because it'll let you pick how you're taking them out, you're always going to want to do it as a loan first, right? And there's a few reasons for that, right? The first is the IRS says loans are not income, right? So that's not going to be getting taxed on a high level view. There are some cases where there are going to be some taxes that come into play. So if the policy lapses, right, everything that was kind of accrued on top of that, the money made, that's going to get taxed. When that comes into play, it's going to be first in, first out. So FIFO. There's going to be some different kind of things that pop in there as far as the tax situations once you start diving into the weeds. But when you're looking at the simplistic kind of IRS definition of, a loan on a life insurance policy isn't taxable, right? Now, that's not always going to be the case, right? But it's kind of when you're looking at that general explanation of what they're giving, okay? The other nice thing is when you're kind of diving into this, that cash value that's accumulating in that policy isn't going to be going towards the Social Security threshold, right? So that's another plus. And like I said, you can use this to help supplement, right, for whatever you're getting paid later in life. And if, let's say, like I said, they pass away at, 101 years old and they have this set up as a trust and that's who it's paying out to, right, and it's the right way, a lot more tax advantages there. So it's a really nice way, and that's why this is becoming so popular and you see it all over social media for a lot of those, one percenters or those people who have a very big income. It's a good way to not necessarily get around taxes, but kind of play around in the gray area. And as an insurance agent, it's good to know this. But like I said, don't go diving too deep into the weeds as far as giving the advice to the client. Refer them out to hopefully, some kind of person you have that will dive into that for you. Who hopefully that's really all they do. So keeping all that in mind, you kind of start to see why these are so attractive as far as what they're going to be returning. The other nice thing with this is, let's say, I'm going to back up. Let's say they pass away, right, at year 5. Okay, they paid in what, a little over 500,000. If they pass away, then that death benefit is 1.5 million, right? Because sometimes people will say, yeah, that's a good return, but I could get more in the stock market, right? You could, but if you pass away, there is nothing out there that is going to give you that kind of return, right? What if you pass away in 2 years? You paid in 200,000, you're leaving behind 1.5 million, okay? So there's some nice kind of protection built in there that you're not going to get through just a pure annuity. You're not going to get through the stock market, whatever the case is, right? Is this going to return, the same as the stock market? Probably not, right? If they live forever. But there's some other things built in there, and there are some great tax advantages that they're not going to be getting through the stock market. And hopefully they're in the stock market still, right? If they're this wealthy and this is the option they're coming to because their financial advisor or somebody told them, hey, this is a good route, right, for where you're at with your tax bracket and what you're going to do. Hopefully, they're already taking advantage of all those other options. Another really popular way to build these is child life insurance. So everyone's seen a lot of the whole life, child life policies that are out there. They're actually really popular, great products, but depending on what state you're in, and a lot of this stuff is going to come down to the states too, because certain states only let you go so young, depending on what carrier you're talking about. You can build these as child life insurance, right? And there's going to be another option for children right after this one. But for this one, we kept it pretty simple, right? We're talking about $73 a month for Tess McTess Jr., right? $250,000 benefit. And like I said, more life insurance focus. So in this case, basically what the parents are hoping for is to have some life insurance. Maybe they're like my mom, right, who bought a term policy when she was in her 30s. She hit her 60s, it expired. She's not eligible to get any more insurance, right? So the term was up. So now she's just keeping that and having to deal with, insane rate increases every year because she still needs life insurance with my dad, right? They're still buying houses, still working, still doing all this. But she doesn't have any other options anymore, right? So she's keeping that. So maybe something like that happened and they want to start up, Tess Junior here with something that they're always going to be able to have, right? And a good option for this one is I did a stop pay after year 18, right? So once, little Testy here is growing up and an adult, right? They're going to gift the policy over to him and they don't want him to pay for it, right? And part of, what you're looking at when you're building these is you want to make sure that this is actually going to stay in force once they stop paying. Because if not, then you're probably going to want to play with the premiums a little bit. And like I said, these are very flexible policies. When you go in there and you are in the quote tool, it is going to give you 3 or 4 or 5 different options of what kind of premium you select. As long as you go with a Target or the Max or the Tamra, you're going to be very safe usually. One thing you never ever ever want to do is select minimum premium. That is what's going to get most agents in trouble, right? They're going to build this, they're going to select that. The premiums are going to be about half what this is. It's going to look super attractive. They're going to go pitch it, and then the policy is going to kind of cannibalize itself in 5, 10 years, right? It's going to run out of funds. Um, now, I do say never ever do that. There have been times I've done it, but I can count it on one hand, right? It's been a doctor who just graduated school, started working. He was making good money, but setting up his life and getting stuff done. I sat down with him, was very clear on, hey, starting next year at the latest, you're going to have to start paying X amount, right, to keep this policy in force and building, and so it doesn't go away. So there are times you can do that, right? There's times where, let's say, somebody gets laid off and they have some cash value in there and it takes them 6 months to find a job. They can let the cash value in there pay for the premium, right? Obviously, it's not going to grow at the same rate because they're using it to pay for itself. And if they do it for too long, it's probably going to kind of lapse and go away. But there's a way to do that, right? So in this case, we stopped paying at age 18. It's going to keep growing. Little Testy Jr. can keep this in force his whole life and never have to worry about it. He's going to have some kind of permanent life insurance. Maybe he wants to take a loan out. He doesn't care if it, runs out of money and goes away because he wants to go buy a new car and it's a good down payment. Whatever the case is, right? It's something they can gift them. Another thing to point out, which I didn't mention on that last investment slide, I'm sorry, is that when it comes to these loans, you don't have to pay them back, right? What's going to happen is it's going to come off the death benefit that's left behind. So for people who've been taking out loans once they hit a certain age, right, it's just going to come off that death benefit. Having said that, you do want to be a little careful when you build these or when you have a client calling in and saying, hey, I want to take out a loan of, 15,000, just random number, right? But that's probably going to make this policy dissolve here in the next couple of years because there's going to be no more cash value, right? So just something to keep in mind. And if you don't know what's going to happen, you can always reach out to us or the carrier, and they're going to let you know, right? This is what's going to happen. And one thing some agents will point out when we talk about level premiums is they're going to be like, well, yeah, but sometimes it goes up because you have to keep it in force. Usually that's going to come into play where, like I said, and random numbers again, they borrowed $15,000, right? And then starting next year, they're going to come in and say, hey, you're going to have to start paying this or pay this loan back to keep this in force, right? Doesn't mean they have to. The policy is going to dissolve if they don't. It's going to go away, but they don't have to, right? So there's a bit of a difference, right? Another option for children is going to be more of, and I called it child investment here, but a lot of times I build this as a college savings plan. Part of the reason for that is, one, it's not going to go against what they qualify for when it comes to getting loans and stuff like that or getting assistance, right? Versus an actual college savings plan, which does. So they're going to qualify for less money, right? Because they have a college savings plan versus if you do it this way, it's not going to impact them, okay? They still get all those cool tax advantages, all those different things we talked about on top of that. And also, let's say that he doesn't go to college, right? He can use this for some kind of other schooling that may not qualify for actual college savings plan. He could use this to go travel the world and take a gap year. He could keep this in place until he hits 35 and wants to buy a house and he has a really healthy down payment, right? There's a lot more options when it comes to building an IUL as a college savings plan than using a true college savings plan, right? And also there's life insurance built in. So in this case, I upped the total initial death benefit to 500,000. The initial premium outlay, 243 bucks, decent number, but like I said, we're doing this not as life insurance, where normally people are trying to keep it as cheap as possible. We're doing it as more of an investment, whether that's going to be for college or whatever the case is. Still had it stop paying at age 18, but in this case, right, hopefully they're around $60,000, right? Now, 18 years from now, that's probably not going to pay for a whole lot from school. But like I said, you can scale this up and down, which is kind of nice. Depending on what the budget is, how much they have to put into it, what they're really hoping to get out of it. And like I said, let's say he doesn't go to school, right? Maybe he makes it to age 23. This policy is growing to hopefully around just under $80,000. Maybe he wants to go look at buying a condo or a house or whatever the case is, right? There's going to be money in there for something. Now, if he takes too much of that, like we said, can kind of wipe some things out, but it's just part of the flexibility with how you can build these. Quite honestly, there's a lot more we could get into, right? We can get into long-term care riders and adding that on there. We can jump a bit more into the accelerated death benefits that are built into some carriers, right? Just automatically, and all the different things you can do there. There's so many different ways that you can build IULs that if you're not utilizing them a bit more, you're really missing out on being able to service your clients as well as bring in some good commissions. I mean, yes, you're really only going to get paid for the first year mainly on most life products, but you're talking about a lot bigger premiums in most cases. And there's value that's going towards the client, which is really going to help them out and fit a need. And like I said, a lot of what I do, I will do an IUL with a term, right? Don't be scared to mix and match. Don't be scared to talk about an IUL, to help supplement an annuity while talking about an annuity while getting into long-term care or whatever kind of mix and match that you have going on, depending on what the circumstance is, right? That's where that whole kind of fact-finding mission comes in when you're talking with them. There's just a lot of different things you can do, and you can keep IULs as simple as you want, or you can get as complicated as you want, right? But there's a lot of fun areas for different segments of the market that you can build them to really cater for. Obviously, they're going to have their pros and cons just like everything out there, but don't get scared off because you've heard clients from the 90s who've said, "Oh, this didn't, return the way it was supposed to," or "this dissolved and lapsed," or agents who say, "I'm never going to get into that because of this," right? It's a slightly different product than it was. Regulations surrounding it are different than they used to be, right? It's why the illustrations are a lot more clear. They're trying not to overpromise on certain things, right? It's just quite honestly a better product than it used to be, like most things out there. So it's something that you can really get into and kind of look at, but there's a lot of different ways to build that. Now, as far as you guys heard me mention different carriers, different policies. Um, I'm not going to throw out the exact number because they're all a little bit different on what you can do with their IULs and how you can build it, right? So the easiest way is to give us a call if there's something that caught your attention, right? Say you want to get more into kind of building IULs as an investment. Say you want to get into more hybrid stuff with long-term care, right? Every carrier is going to have kind of their niche where they're going to fit the best. And the easiest way to kind of give that out instead of just throwing out general information to everybody is for you guys to either give us a call at 800-672-7202 or simply ask us when we're doing our follow-up calls after that, right? What specific questions are you looking for? What are you trying to learn, right? We're always here to help. And if you have a case or a client that comes in and you think they might be a good fit for something we talked about or something you're curious about, give us a call, right? We always want to help and we want to provide you with the best illustration, the best product, the best solution that's not only going to take care of your client, but help you close that sale, right? Because at the end of the day, you do need to make money, right? You do need to be able to stay in business to keep servicing your clients, right? And a lot of agents lose sight of that. Buddy, for being here today. I want to thank Courtney for the intro. And we will be following up with you guys on some calls here shortly just to see if you have any questions. But I wish everybody a great day. Thank you.